Morning, gentlemen.
Morning.
Morning, morning.
Morning.
How's everyone? Okay?
Yep.
Yeah, not too bad, thank you.
Perfect. Okay, well, good afternoon, everyone, and thanks for joining us today. What should be an exciting and informative webinar with our panel of experts. I'm your host, Greg Stockton, Commercial Manager for Finsbury Associates, our UAE-based financial planning firm. Now, today, I think we can all agree that 2020 has been a very interesting year. We started the year off with wildfires in Australia. We've had killer hornets in America, Black Lives Matter protests, continuing Brexit discussions, COVID pandemic, now further lockdowns in UK and Europe, all of which is in the middle of an election year with Trump and Biden. That said, even with all the chaos, we've still had some huge opportunities within the market, with the S&P currently up over 1% this year to date, the NASDAQ over 21%, tech sector 19% up, retail 15% up, healthcare sector 9%, and companies such as Tesla, Netflix, Amazon, and PayPal, all with over 50% returns year to date. So still opportunity in what has been a fairly chaotic year. Today, as I said, I'm joined by three industry powerhouses and vets. Firstly, Peter Duke, Director of Middle East and Africa for Fidelity, David Coombs, Head of Multi-Asset Investments for Rathbones, and Tom McGrath, Partner and Founder of 8am. Gentlemen, welcome.
Thank you. Good to be here.
Same, thank you.
Tom, David, you're currently in the UK, so we've got you up a little bit early, I think. And Peter, you're based in the UAE with us, right?
Correct.
Yep.
Awesome. Okay, so just a little bit from a format perspective this afternoon or this morning, wherever you are in the world, I'm going to give each of the panelists 5 minutes just to introduce themselves, a little bit about their background, and of course how they manage money as a company. Once we've gone through that, then I'm just going to go straight into sort of a 30 to 40 minute question discussion. I've already had around about 20 different questions emailed in from people watching this webinar today. For you guys that are watching, if you have any questions that come to mind, feel free to pop it into the chat or the Q&A box, and we'll try and get around to that during the 1 hour that we've got the panelists for. So if I can start with you, Peter, that would be fantastic. And yeah, go ahead, introduce yourself, the company, and how you guys manage money.
Perfect. Well, thank you very much, Greg, and good afternoon, everybody. Thank you for joining us. As Greg said, my name is Peter Duke. I look after Fidelity International's business here in the Middle East. I've been with Fidelity now for close to 17 years, most of that time based here in Dubai, so close to local investors and local concerns. Fidelity offers a very extensive range of mutual funds, all of which are available through the various savings products and platforms that are offered by Finsbury Associates. So you have access to our full range. When you look at Fidelity's range, it's underpinned by a common theme, which is an extensive research platform, one of the largest in the world, which means lots of analysts and portfolio managers looking at companies each and every day of the week to understand what drives those businesses, how they are going to be profitable in a variety of different economic scenarios, and using that insight to build the portfolios and the funds that are ultimately available to you through Finsbury Associates. One of the things that has been brought out across the course of this year is the benefit of experience. And Fidelity International, now over 50 years old, has been through volatility, has been through crises before, and therefore, whilst it's unpleasant to live through, there is some comfort that there's always light at the end of the tunnel. And companies that do a good job during difficult times tend to emerge stronger from each and every crisis. And that's certainly, I think, been one of the experiences of Fidelity as we have grown our business, not just here in the Middle East, but globally over the last 50 years or so. So that's my pitch for my company. Back to you, Greg, and on to the others. Thank you.
Thanks for that. Fantastic. Tom, if I can go straight over to you, please.
Sure. My name's Tom McGrath. I'm Chief Investment Officer of a boutique investment management company called 8am Global. We run about 500 million of assets under management. We're a specialist investment company just looking to drive the best possible returns for our clients. One of the things, I guess, that sets us apart is we're able to go and invest where we see the best opportunities. That might sound absolutely obvious to everyone, but a lot of investment management remits and mandates are very much aligned to benchmark performance, whereas we can basically invest where we see opportunity. And 8am Global has been set up with an emphasis on investing in the future, where we see the best opportunities. So a lot of the new technologies that prior to this awful pandemic, people were just starting to adopt, a lot of those are becoming mainstream. So we believe people will, largely work from home, they'll shop online, they'll need cyber security, robots will run factories. So very much more looking to forward technologies. But it's a pleasure to be here on a grim Monday morning in the UK. Thank you.
Fantastic. Thanks, Tom. And David, finally, if I can just finish with yourself.
Yeah, good morning. My name is David Coombs. I run the multi-asset funds at Rathbones. Rathbones has experience since 1742, but we built ships then, so not sure it's particularly relevant. But I've been running money for 35 years through some quite hairy moments, of which is why I don't have much hair, clearly. And we're going through yet another crisis now, and hopefully that experience is helping us navigate our way through this with some kind of control and sense of calm. We invest directly in our funds. I'm running around 1.9 billion in the funds that I run at the moment. My pension fund is entirely invested in my funds, as are my family, so we're in it together with our investors. I think that's important, but we invest directly. I don't outsource to external or internal managers. So any winners are mine, but any mistakes are mine. So I'm totally accountable, and therefore who's running the money. I worked for Barings prior to joining Rathbones 13 years ago. I was there during the Leeson crisis. So not just having market crisis experience, I've also worked in a company that collapsed, and that had a big impact on the way that I look at risk. And I bring that to bear in the way that I run these funds. So I'm looking forward to the questions. I won't know all the answers, but I'll certainly give you my opinions.
Fantastic. Thanks, David. Okay, guys, I think I opened up with a sort of introduction about the opportunities that have come out of the markets this year, even through all of the crisis that we've had to go through. But obviously, I guess the initial concern and the thoughts on everyone's mind today is elections and what that's going to mean. So I'm going to kick off with that question. So a quick fire round of who do you believe is going to win the election? Peter.
Nice, easy one to start with. Excellent. I think that there are two things that we're looking at. One is obviously who wins the election and with what type of majority. And as a result of that, do we end up with a divided or united government? That's key. But also, at what point do we actually get a result? And if it is contested, it could be another month or so before we have any clarity as to who is in the White House next year. And that, as we will discuss later, brings uncertainty, and with that volatility, so it's something we need to bear in mind. Our base case scenario is that Biden wins, and we attach around a 65% probability to that. A small probability that he wins with a big sweep, which then gives him a mandate to implement an awful lot of the plans that he has spoken about. More likely is a small sweep, so the Democrats do control the functions of government across the three power bases, and that then gives the US a clear path as to what it wants to do over the next 4 years. Less probability that Biden is in charge with a divided government, and actually even in our view a lesser probability that Trump is returned to power. We put that at around 15%. Okay,
who do you want to win?
I want West Ham to win the Premier League, and that's about as far as my wishes are extended into this situation.
think we might be on the webinar a bit too long for that to happen, Peter, to be honest with you. Most of us might be dead by that point. Okay, David, your thoughts on the election of who wins and who you want to get office?
Well, I think everyone loses, to be honest, at the moment, the way it's looking. I think Kamala Harris is probably the big winner, actually, and she's probably be president for the next 4 years. I kind of don't care who wins. I'll answer the second question at the same time because I'm not sure that was coming. From an investment point of view, as long as there is a winner, that's kind of the main thing. It will have, if Biden wins with the Democrat Senate, the market will go up because it's going to get drunk on fiscal cash thrown at the market. If Biden wins and Republicans retain the Senate, then we'll probably see the market a bit wobbly for a few weeks. And if Trump wins and retains and Republicans win the Senate, we're kind of where we are. So all three don't particularly bring much fear to me, to be honest. And if the market wobbles in any of those scenarios, that is a buy case. And then in 3 months' time, we'll wonder what the fuss was about. So who's going to win? Well, the bookies tell us it's Biden. They're not very often wrong. So my money is with the bookies, I'm afraid. Really boring.
Okay, no, fair. Tom, any conflicting opinion?
Sadly, no conflicting opinion. Very much agree with what David just said, actually. Elections are sort of largely a sideshow for the long-term direction of stock markets. So I think the markets would deal quite happily with the blue wave or Trump getting back in. I think the point is valid if it's contested and there's riots on the street. They're not going to like that. And we are going to have a bit of dead time between now and when the new president gets inaugurated on January the 20th, which will be quite painful because the US economy is screaming out for a fiscal package. So you'll have time for that buying opportunity, would be my sense. Although a blue wave would probably drive the markets higher, as actually would a red wave. Who I think is going to win, I'm probably a bit more confident than the other two that Biden's going to sweep the House of Representatives and the Senate. He probably won't get the 60 votes he needs in the Senate, but he'll probably take control. And if you look at the polls, there were within a margin of error in 2016. There were about a 3-4% lead for Hillary Clinton going into that one, which is actually in an acceptable margin of error within polling. Currently, Biden's got about 7-point lead, 7 to 8 point lead, which is a sort of second standard deviation event, which suggests in the realms of probability he's sort of more at 80 or 90%. But the odds aren't. The odds, I think you'll probably get 1.5 times your money on Biden, and actually I think that's quite a good bet because there's a lot of rogue money on Trump just because of what happened last time. So a smart bet, if you believe in odds and probability, would probably be Biden with the bookies.
Yeah, I think you're right. I think, if you look at the polls last time, they were wrong. You've known better to be right. You can't rule anything out, especially in 2020, right? When it seems anything is possible. So let's just talk about, if Trump retains or if Biden gets in, what sectors are going to, I guess, suffer and what do well out of each one of those probabilities. So I guess let's start with Biden getting in, as we've all agreed that that's probably the most likely. Are there any sectors that are going to suffer with Biden getting in, and are there any sectors that are going to start to thrive, i.e., what would be a good investment opportunity for people if that happens? Tom, I'll start with you.
Sure. Well, Biden's made big noise about his green energy bills. So spending an awful lot of money, not only in green energy, but also infrastructure. So you've got to logically think that both those sectors will get favorable tailwinds from the Biden presidency. He won't be doing any of that immediately. His primary concern will be fiscal stimulus. But I think if he did get elected, you would see a spike higher in a lot of the green energy and some of the infrastructure plays. But I'd almost be tempted to sort of bank that and be patient, because it'll be sort of 2022 before the big spending starts. He's probably a bit more pro-European than Trump. Trump, for some reason, sort of decided to create a division with Europe and try and make Europe his sort of whipping boys. I think Biden's much more conciliatory and will look to strengthen ties with the Europeans and encourage trade. So you could actually play a Biden presidency through European exporters. So I think it's probably good news for Europe as an area to invest. And actually, just on the world stage, Trump's been a bit unpredictable, cozying up with directors, periodically having a pump at China, and that's all been a bit, risk-inducing or nervousness-inducing. I think if you get a calmer president, as you will with Biden, it's still, fight the battle with China, but I think that is quite a nice stabler to risk investment in emerging markets. So I think emerging markets could be a left field beneficiary of a Biden
emerging markets, potentially Europe. Obviously Europe, I think Euro stocks is down over 20% this year so far. So that already represents a decent opportunity for a buyer anyway.
Yeah.
David, do you see any sectors that suffer in the short term or long term with a Biden presidency?
Well, the market will think so. That's the most important thing in the short term. It doesn't really matter what I think. I position for Biden win. I don't make predictions, but I position for what I think is the most likely outcome, because that's what affects markets. And so I've been building up positions in the Russell small cap indices, which has bigger exposure to value and energy, etc., renewables. That's just a hedge on Biden getting a clean sweep, and you see this blue wave. Politics has much less impact on the economy in the US than often we think, whether it's Clinton, Obama, Bush, etc. And markets get hugely excited every election cycle. I would just be slightly cautious on that. Good companies are good companies, right? Microsoft will be a good company throughout this 4 years term, whoever's running the US. So I think the core of my portfolio is not going to change. You want to be in, we'll come on to this later probably, technology, medical technology. I think that med tech is going to be a big winner, not just in the US, but globally. We need to get costs down on healthcare, and med tech is the way to go rather than pharma. So I see that as a big winner. Typically people say if the Democrats get in, it's bad for financials. You could see Google and big tech come under pressure, antitrust. Good luck with that is all I'd say. They've got deep pockets and they can be wrapped in courts for many, many years. So I wouldn't get too concerned about that. I think that the situation with China is probably much more on the front of Biden's to-do book. So you get renewables. You could go out and buy cement makers, I guess, if you really want to play that. I'm not going that way, I'm afraid. I'm sticking to the global trends, and if we see this massive rally in those sectors, I'll be a seller, to be honest, and then we get back to normal.
Okay, Peter.
Yes, very much in agreement with what's already been said. A Biden win, particularly a big sweep, is going to usher in huge fiscal stimulus, up to $8 trillion. But actually, even if it's just a small sweep, the numbers are still massive. $5 trillion being spent initially on the COVID plan, which he has spoken about at length. So it's very much front-loaded fiscal stimulus. And with that amount of money and with the levels of debt in the US, reflationary trades, are definitely part of where you can make money if he's able to pass the legislation that he wants. So, small cap, value, some of the areas more linked to economic activity, in theory should do better, infrastructure, materials and the like. So those are areas to watch. In terms of the legislative program, there are some risks for all sectors. I think, technology, it's the darling of the stock market, as you said at the beginning, Greg. It's led the US higher, not just this year, but for the last couple of years. I think there are some structural challenges facing technology companies, which will come from more legislation, maybe even breakup of big technology companies, and looking at areas like fines, data privacy and the like. So some headwinds for those companies from the government, albeit that the structural themes are very much in place. They still, will navigate that, but some challenges. And then I think if you look at the other areas like energy and healthcare, again, a different agenda to Trump. If he's able to implement, then that has some negative connotations, particularly in the energy sector for certain companies.
Okay, perfect. Great answers. Okay, so I'm just going to run through some of the questions we've had in then as well. So are the FANGs a fad, or is there major long-term value in holding these stocks? David, start with yourself.
So I'm not a massive fan of the term FANGs, let alone some of the FANGs. So I think there's a lot of hype in certain areas. They're not necessarily, I mean, they're good companies, but I don't own Apple, I don't own Netflix. I do own Google. I don't own Facebook, but I am overweight technology because I prefer pure technology plays rather than some of these media or retail companies that I don't think are really tech. I'm always nervous about stocks that are hyped up, and I'm willing to sort of take a back seat. I do like Alphabet and Amazon. I think they're utilities now, and and yes, they will come under pressure. Of course they will. But already Amazon's seeing competition from the likes of Walmart coming onto the distribution market, Shopify helping smaller brands take Amazon on in niche areas. I think those areas are being tackled. So I still think Uber's a taxi company, not a tech stock, and Tesla's a car company, not a tech stock. And Spotify is a music streaming business, media company. It's not a tech stock. So I would be cautious of some of the FANGs. I think they're overhyped over there and should stay over there. But technology where you're properly bringing in efficiencies to manufacturing, that is, and the increase in computer power that we are going to see over the next 3 to 5 years is going to have a fundamental impact on most sectors. And so let's get away from the FANGs, and the Robin Hood buyers and go and look at proper technology companies. They're going to drive the next sort of cycle, I guess. I think it's really exciting.
Yeah, I agree. I mean, Tom, obviously you're big into the tech play. What's your thought on the FANGs and what David's just commented on?
I think what David just said was incredibly powerful. To me, the way you're going to make real money over the next 10, 20 years is kind of investing early stage in an Amazon or an Apple, like 20 years ago. So I think the opportunity lies in small and mid-cap tech that are developing the sort of spin-out sectors like cybersecurity, like medical technology, like he said, like artificial intelligence plays, all the sort of peripheral new technologies, I think, are going to do incredibly well. And if you can find the right stock, you're going to make a lot of money. I mean, I think the best way to play that actually is index trackers of the new sectors, and I think that way you make a lot of money. In terms of the big FANGs, you can argue they're overvalued. But these are companies that are generating earnings growth in excess of 20% per annum. They don't stay overvalued for long if they keep banging out, earnings along that sort of line. And it doesn't take many years of 20% earnings before they become cheap. And they've got good management teams. They've built sort of barriers around their business models. So, new players can scrape around the edges, but it'll be very difficult to replicate something like Amazon. To my mind, when there's a bubble, for it to be a bubble, something needs to prick it to destroy it. That historically has been rising interest rates. That's got rid of all the bubbles of the last 20 or 30 years. And I don't see rising interest rates anytime soon. So I think you'll see a sort of gradual deflation of this sort of overextension. But I think I don't think it will be a collapse in share prices. I think their earnings will probably outperform their share prices for the next few years. So I'm, and particularly with COVID flaring up again across, the developed world, well, everywhere in the world, these big companies that can, drive revenue growth in a shutdown environment, you'd always want to have some of your money invested in, I believe.
Fantastic. A couple of questions just come through on the Q&A. Peter, I'll start with yourself. Any thoughts on emerging markets? Most are struggling under the weight of the global uncertainty. However, they do provide greater margins of return.
Yes, and actually just to comment on technology, because it links into emerging markets, is, it's definitely not a fad with the FANGs, but just think of the trade war with China. That is a technology war. So, the likes of Amazon and others will lead US technology, but they will come up against world-class Chinese companies that are going to compete with them head to head in other markets. And that's really behind a lot of the rhetoric from Trump, which will continue with Biden in the longer term, because they are fighting for hearts and minds in Europe, Africa, and beyond. So, that is a key area, I think, for the next 5 years. You think of technology in China, ZTE, Huawei, far more patents than the equivalent US companies, dominating in some of the new technologies. And that's where also potentially, if you're able to diversify and look at opportunities outside of the US, huge opportunities within technology in Asia.
Yep.
And on that basis, I think when you're looking at emerging markets, I think valuations currently are still pretty attractive. And, there is economic growth led by emerging markets in Asia, principally China. And so I think when you look at equities, which you can take maybe a neutral view, if I'm putting money to work, I think Asia and emerging markets is definitely a recipient. But as with all of these areas, I think it's incredibly important not just to say emerging markets in general. I certainly wouldn't be buying an index fund because it encapsulates so much. Very selective stock selection, very specific about the risks that you want to include within a portfolio, and actually really understanding companies that you're buying and what drives their profits is the way, I think, to make money in emerging markets, but generally positive.
Okay, interesting. David, do you guys hold much emerging markets at the moment? Is that a sector? Is that an area that you feel that has growth potential?
So emerging markets are tricky because I don't think it exists as an asset class anymore, to be honest. So let me tell you how we approach at the moment. We do like China and have been increasing China all year. I don't see China as an emerging market, to be honest. It's probably the biggest economy in the world, and yet it's about God knows what small percentages world index, which just shows that index tracking doesn't make sense a lot of the time. So China is a big part of it's a reasonable part of our portfolio. You've got to be slightly careful because there's still governance issues, and you don't have the transparency and visibility on government policy. So it is still sort of 4 or 5% of our kind of medium risk fund, but we don't have anything else in emerging equities. Not really interested in Latin America, not particularly interested in Africa and Europe. So that's where our emerging market equity exposure is. But like I say, I don't really think of it in emerging market terms. We've had a much bigger position in emerging debt since March, April, when you saw some big defaults, and we took that as an opportunity to buy into the recovery in emerging debt, and that's played out quite well in the last 6 months. I still think there's with COVID still hanging around, there's still value in EMD and emerging currencies, but clearly, that's in the risk on part of the portfolio, not the risk off. So we think if you're getting, when you're getting the yield you're getting, or potential yield on EMD back March, April, didn't really make sense buying the equity when you've got these high single digit potential yields on good, sort of reasonable quality credits.
Yeah, I mean, what's the biggest risk for investors at the moment buying sort of EM debt though?
Oh, well, inflation. I mean, EM debt is all, the dollar sort of strengthened significantly for those countries that still have significant external debt in dollars. That's always the risk for EMD. We've got a mixture of corporate and local currency debt in emerging markets. It's high risk, right? So this is why we don't have the equity weighting as well. It sits there in place of. So it's one of the first asset classes to sell off when markets become negative. So buyer beware.
Yeah. Okay.
But they are still on quite. They are still quite on low value. So you're not buying anywhere near the top of the market. And there's a lot of money chasing yield right now. So there are some natural buyers, even if they shouldn't be.
Yeah. Absolutely. Tom, emerging markets opinions?
Yeah, largest position in my main fund is in an ETF that tracks emerging market e-commerce. So high conviction there. It's simple. Some things in the world aren't predictable, but some things are predictable. And demographics are predictable, and also the point at which people consume product. And what you will see from the emerging market world is we've got about 2 billion new consumers moving into that space, a combination of them getting old enough and them earning enough money. And how do you think an emerging market consumer is going to buy his goods? He's not going to stroll down to the shops, he's going to buy it online. So we've got an ETF that targets that incredibly high growth opportunity. It's sort of largely in China, other bits of emerging Asia, and also in Brazil. So if you can imagine, that's a lot of potential Amazons of Asia lurking in that ETF. And other than that, no direct holdings, but again, within some of the ETFs, the new technology ETFs, we have a reasonable weighting to emerging markets. We've just bought an EdTech, educational technology ETF, because we think, that as this crisis has brought us all to realize you might occasionally have to educate your kids from home, but also you can educate your kids from home. And certainly the model in a lot of Asian countries now is, seek out a world-class education, but online for your children. So yes, I'm very positive on emerging markets.
Super interesting. I mean, I've had my own daughter trying to do online learning this year, and it's quite an interesting challenge in itself.
It is. Yeah, snap, 2 boys doing that.
Fantastic. Okay, so just quickly going back to US election results, just a question that's come through. But it goes back to the UK. So will the US election results affect the sterling and any potential Brexit process going forward? Obviously the high potential in Europe. Peter.
Oh, I thought we'd go to our UK panelists first. I think the outlook for the UK is uncertain. Lockdown and Brexit negotiations are the 2 variables. That feeds into the currency. I think because potential negative interest rates, more quantitative easing, when you maybe get a fall off in economic activity in the short term, in theory is negative for sterling. That said, I think the dollar will be weaker in the short term as well, just because of the scale of their fiscal stimulus. So on that basis, sterling relative to dollar, stable, maybe a little bit stronger. But I think, too many variables for the UK in the short term to really have a positive call one way or the other. But to the UK experts.
Okay, cool, David. So any sort of effect on the UK with the US election?
Not really, to be honest. I think again, trade agreement's a bit of a red herring. I think the action is the dollar sterling rate. You've got 2 key variables, as Peter was alluding to. You've got the dollar in terms of how international markets look at that fiscal stimulus, but in Europe, you've got many countries being downgraded by the ratings agencies because of their approach to lockdowns, etc. So you've got everyone. It's like 10 drunks in a bar all trying to get to the floor first, and is where I see it at the moment. So I think I think the UK will have a deal on Brexit. I think the EU and the UK desperately both need a deal now. They're not going to let some haddock fishermen destroy a deal across the 2 major economies. So there will be a deal. There is potentially room for a sterling relief rally if that happens, despite the second lockdown here, which in my view is a mistake. But you could see sterling rally against the dollar if the dollar is also weak at the same time. Now we've hedged 70% of our US dollar exposure. We have big weightings, as we alluded to earlier, in US equities and US treasuries. I was buying US treasuries on Friday. Again, with the yields at 85 bips, but we've hedged 70% of our US, we've hedged all of our euro because we think there's a risk that sterling breaks out to 135 against dollar, and that would hurt our overseas investments clearly. In a world where you're eking returns out, you can't afford that hit from currency. So to us, currency is a risk rather than opportunity at the moment. Fundamentally, they all look unattractive equally, but as sterling-based funds that are then hedged into other currencies, sterling is a risk to us. So that's how we're playing it. Having said that, I am long Singapore dollars, Japanese yen as safe haven, and Swiss francs, because I want some safe havens in the funds as well, in case we do see another big sell-off if death rates rise dramatically again in US and Europe. So it's a really difficult time for currencies. I mean, predicting currencies is always mad. I don't do it. But right now, our hedging strategy is right to the fore and reviewed literally on a daily basis.
Okay, nice. David, great insight. You mentioned obviously the second lockdown. In your opinion, obviously, you just made it quite clear that it shouldn't have happened. I guess that will have varying opinions across the UK. But I'll go to Tom. I think the market's open, UK in sort of 20-25 minutes. What is the short-term effect of this lockdown on the FTSE and UK companies?
Well, actually the FTSE has opened up.
Oh,
This morning.
There we go.
I'll tell you what it is. I haven't even looked. I've been so absorbed. I've got it pretty much flat. So there you go. That might be because sterling's come off a bit, and that's favoured some of the the exporters in the FTSE. Because I would have thought the second lockdown isn't good news for the UK economy. Flatly. Whether we should have done it, whether we could have worked it regionally, I'm not sure. I think public pressure was gathering anyway that Johnson had to, and there's going to be a bit of a drama in the politics because Keir Starmer, the Labour leader, does seem to be scoring points left, right, and centre, but against a government that's kind of hopeless to. It seems the virus is dictating economic policy and government response at the moment. The virus is in control, and it will be in control until we get a vaccine and we get the widespread use of that vaccine. I think David summed it up perfectly, really. I shouldn't add much more on that. US politics isn't going to influence sterling. It's, do we get a trade deal or not? The odds are probably we do get a trade deal. Sterling could well spike to 135, maybe a little bit higher, and it's a good idea to hedge against that. Conversely, if we hit strong waves, third wave in the US, and the world looks like it's going into lockdown, the dollar actually is quite a good reserve currency, and the dollar would appreciate against sterling. But like everything in fund management, there's almost an equal and opposite argument, and that's why there's a price somewhere in the middle.
Okay, I mean, staying on the lockdowns for a second, because I know it's a question I had from a few of my own clients in the last few days, and I know some of the advisors here have had similar ones. You have got UK in a second lockdown and potentially extended past 2nd of December. You've got Europe going into further lockdowns. If you're an investor right now and you already have equities being held within UK and Europe, do you hang on tight? Do you get out of the markets? If you're a new investor, do you go in now? Do you sit and wait and just see how sort of the Christmas period pans out? I'll start with you, Peter. Where's your head at in terms of, if you're a consumer, you're an investor, and you've got some risk on the table at the moment, you've got some new asset or some new cash to deploy. Do you sit? Do you go in? Where are the opportunities across UK and Europe?
Can I have a one-word answer to that? No follow-up questions? I jest. I mean, it's a tough question. I mean, I think, the key actually, and this is where Finsbury and your advisors have a key role to play, I would say, is first of all, just looking at, the longer term objectives. And if that is, to retirement or, savings in 10 years' time, then that risk that you have in your portfolio is essential and should be maintained unless your circumstances or your attitude to risk have changed dramatically. And so the fluctuations that we see now, if we think back to March, those drawdowns have been recovered. we've had accommodative fiscal and monetary support, and what looked disastrous in March, as we've seen even from the numbers you quoted at the beginning, has definitely led to opportunity. So I wouldn't be taking knee-jerk reactions, even when faced with another leg down in the recovery, because we recognise it's not a clear picture. And actually that second stage of the recovery is going to be even more challenging than the first, because you've got to deal with some of the permanent destruction that's been created in economies generally. But I definitely would maintain the plan. And if that has risk exposure, I think absolutely you need that at the core. Where you're making decisions, it is around the edges, to be honest. It might be increasing risk, as David said, with the emerging market local currency exposure, but that's in proportion to what you're expecting your portfolio to do. I said back in March, I put money to work in a global fund and in an Asian fund when I saw markets fall, because it wasn't a lot of money, but also it was something that I thought, again, you look at fundamentals and think, there is something in there. And I'd be inclined to think about something similar this time around, to be honest. Not full portfolios, not betting everything, but certainly taking selective bets where possible. And I do like Asia as a potential destination for that money.
Okay, cool. David, for the lockdowns, UK and Europe, what do you do as a client right now? Where are those opportunities?
So I don't think the lockdowns make a huge difference, to be honest, to what the opportunities were pre or prior, because most of the trends that are driving through COVID were here before, so they're just being accelerated. So as I said right at the beginning of this webinar, I've been doing this for 35 years, and one of the things I've realized is that I know less now than I did 35 years ago in terms of timing markets. So first of all, don't. What I've been doing last week or so is picking up names that are the sort of second derivative of e-commerce, like Keon, that kits out distribution centers, Amazon and robotics and whatever. These are good companies that have fallen in the last few weeks, and I'm adding those to the portfolio. And the reason I'm able to do that is that I'm not timing the market, but I do have significant cash positions. I've got put options on the S&P 500 that's ensuring some of my equity exposure in case we do get a sell-off. And I've got a significant weighting in government bonds, global bonds, and gold. So I'm running below my average risk level in equities. So I'm invested, which makes me feel comfortable in sort of high growth areas like tech and emerging debt. And yet I've got plenty of powder dry in my fund if the markets would sell off, which is what I did in March and bought heavily during March. And I would just do the same thing again, because it worked in March, it'll work again, and it'll be in the same sectors where I can see a 5 to 10 year growth trajectory. I'm not going to be clever. I'm not going to buy airlines or cruise liners or travel agents. I'll leave that to the equity guys and the high risk guys who want to do that kind of timing. That's not what I do. You need to look elsewhere. If you want to make 3 times your money on buying Carnival, go for it. I did buy some Carnival bonds earlier in the year and sold them again, but I'm not going to play the equity. No way.
Okay, interesting. Tom, any other thoughts?
Yeah, I think if you had to invest some money now and you couldn't look at it for 3 years, would you put it in bonds? Would you put it in equities? Where would you put it? And I think you put it in equities. I think we're trapped in a lot of pain at the moment. We've just had an awful lot of bad news, not just in the UK, but the virus is spreading across the world. Big fiscal package that was going to come in the US and save the US economy and de facto the world hasn't happened. We've got US political uncertainty. It's grim, and we're heading into a winter where virus numbers are going to go up. So it's all bad news, and unemployment is rising, and there's a lot of things to be scared about. And that actually is typically the right ingredients for a buying event when you least want to. And I would suggest we're very close to that point now. What we're going to have next year is an extraordinary combination. This happens once, twice in an investment career, even as long as David's. And I once had hair too when I started managing money. This was the FANG bubble. No, it started going back in FANG. It was the global financial crisis that finished it off.
To be fair, there is a common theme between all three of you, actually.
Experienced investment professionals. You know, we've gone through it. But no, I think there's this once in a lifetime opportunity, which is we are going to get the combination of very, very loose monetary policy, interest rates pegged really, really low, with fiscal stimulus coming through globally, and with no risk to that scenario. You know, people are, particularly in the US, they're going to keep the foot to the metal until we get economic growth, you know, really motoring. So I think that's a heady cocktail for equities: low interest rates and big fiscal stimulus. And we're going to get a vaccine, you know, at some stage between now and, you know, June of next year. And we're going to have economic recovery picking up, and we're going to have corporate profits going up. So if you can take your mindset out of right here, right now, and put it forward into spring coming, vaccine arrived, fiscal stimulus in the US, you know, people going back to work, I think this is a real buying opportunity. Might get better short term, but, you know, 3 years plus, I think this looks like a wonderful entry point. And that's across value growth. You know, there's in equities in general look attractive to me at these levels.
Yeah, I agree. I think if you've got a long-term vision of investing and you can, you know, potentially drip money into the markets right now for maybe the sort of next 3, 4, 5, 6 months, just to, you know, take some better opportunities down the road. I agree. I don't think there's ever been a better time to be investing money, especially in, I think, what all three of you have probably commonly linked together, which is that tech sector. Whether that be, you know, UK, Asia, emerging markets, or America, the potential for that sector long term is absolutely huge. Onto that, Peter, I've just had a question that's come through specifically for yourself. I have some savings. I'm looking at investing about 80% of it. I want to maximize gains over the next 3 years and looking at Chinese markets. What would your advice be?
Not all in China. As I suppose, as David said earlier, I mean, China is underrepresented in global indices. You know, whether it's debt or equity, it's a huge market with huge potential, but it does come with risks. Governance historically has been an issue. Can we trust information that we get from government and from companies? Hence, on the ground due diligence is key. And then understanding government policy is also obviously very important, because, you know, unlike, and again, I go back to the technology sector here, you think of the growth of Chinese technology companies, they have been done in tandem with government policy. So Tencent, Alibaba and the like, you know, there's no surprises. There are government officials on the boards of those companies. They understand where they're going. And so therefore they are in part an instrument of government policy, but obviously if they are delivering what's expected, they are major beneficiaries, as we've seen with both of those two companies that I mentioned. US, its legislation catches up. Technology comes first, makes money, and then politicians think, how do we rein this in? Which is why I think that legislative reform will come, particularly if Biden's in power. Sorry, I know that doesn't answer the question, but I think with China, I think, again, it's the longer term view. You do want exposure, but I would be buying that not through ETFs. I would be looking at actively managed funds and looking at companies that actually have the resources on the ground that are actually able to properly assess what it is that, you know, constitutes a winner in that environment. So active management, strong resources, and a time horizon that allows you to really benefit from that investment.
Great answer. Okay, so chaps, we're about 10 minutes left to run. So just a final question really from myself. Obviously, I know we've touched on long-term potential of markets, buying opportunity right now. For those sort of clients or prospective clients that haven't got that longevity, or they haven't got that time left to take on the risk of tech and those long-term assets, and they are looking for maybe the next sort of, you know, 2, 3, 4, 5 years for retirement as an example, and they're looking to take risk off the table, what should a cautious investor be looking at right now? David, and that's part of sort of, I guess, your repertoire at Rathbones, but what should a cautious investor be looking at right now to still try and take some returns from the markets without taking a stack of risk?
I mean, yeah, I mean, obviously this is a high risk area in a way, low risk investors, because whether it's 2 years or 4 years makes a massive difference. So, you know, I do run a fund for low risk investors with a 3-year time horizon minimum, because I think anything below 3 years is far too risky. How is that fund invested at the moment? Because I guess that's my answer. Well, it's got about 30% in equities, because where else are you going to generate return? I've got put options around those, which aren't cheap, but they offset some of that risk. I do have some emerging debt in that fund as well, but I also have a lot of cash, some big gold positions, and some of the safe haven bond markets I was talking about. So you've got that liquidity in case their horizon even gets shortened, because you want to make sure you're not a distressed seller of any assets. So we run that fund in a very liquid mega cap equity, a lot of government bonds in multiple currencies, a currency hedging overlay over the top. That often has the most active management in the low risk fund, actually, because we take profits much more quickly in that fund to maintain that liquidity. But low risk investing is the hardest to do right now, because you just don't have the yield from the bond markets. Corporate bond markets have never been more risky. They've got the lowest credit rating they've ever had in my career. They're illiquid. The spreads on prices we try and trade are very high. It's expensive to trade in that market. So unless you buy it and you issue and hold, it's very difficult. So there aren't many opportunities outside equities. I guess that's what we've been alluding to all the way through this webinar, right? And so for low risk investors, it's no different. So when I think about risk now, you know, if you're holding Microsoft, for example, it might look expensive. It's got a lot of cash on the balance sheet. It has high cash flow, low debt. That's lower risk. Does that mean the share price won't be lower in 3 years' time? Of course not. It could be. That's the difference between investing in businesses and share prices, right? So, you know, I think a cautious investor still needs to have a third of their money in equities if they've got 3 to 5 years. If they're looking at one sort of 0 to 2 years, you're in cash. Go and have a holiday.
Okay.
If you can travel.
Yeah, you can actually get out the country.
Yeah, sorry, I have a holiday 3 miles to your house.
With only 6 people. Okay, Tom, any words on that as a cautious investor? Or
yeah, I'm going to invest in David's fund. You know, sounds. I mean, that's exactly right. He just highlighted, you know, there's a risk in bond markets and corporate debt at the moment, and you know, if it is that short-term horizon, the client has to be really cautious, because they could lose money, and it's normally because they, you know, they aren't going to be earning. This is, you know, very important savings to them. And I think diversification is your only friend, but it's really tricky when you haven't got bonds there as the natural equity diversifier. So I think you know, holding a chunk in cash, which is an unusual suggestion, is no bad idea. A reasonable amount in equities, and if you can favour, you know, high quality cash-rich businesses, that's a good strategy. And I do like gold as a diversifier. And if we are, you know, what I said earlier about, you know, all this fiscal and monetary stimulus, that means a lot of money is going to be printed. You know, in such an environment, it's quite good to hold a real asset such as gold. So I think gold will be a useful diversifier and offer some protection. The only other thing perhaps to look at is, you know, a global infrastructure fund or something like that, particularly if Biden's going to be, you know, unleashing the bridges and roads and tolls and digging holes and all that sort of stuff. But diversify, you know, don't get greedy with the risk, which is perverse, because, you know, I am bullish from here, but I think that's absolutely prudent for a cautious investor.
Perfect. And Peter, any final words on that? Anything different?
I suppose it shows, you know, what a strange world we're in, that where you go for your safe havens, they're so expensive that if you're buying German government bonds, you're guaranteed to lose money. And that's the safe, secure asset, but it doesn't make any sense at all. So, within credit, if you want the yield, you're into global high yield emerging market debt, and that carries a risk, as we know. So it does depend. If I want to lose no money, I take no risk, which in theory is cash, but negative interest rates means I'm getting nothing. Inflation in some form is going to eat into that return, but maybe I sleep at night because I'm comfortable, but in the long term it's not the answer. So it is, unfortunately, diversification amongst income assets, and that can be equities, infrastructure, alternatives, traditional safe havens. You probably need to have an element of all of those. But actually, I think the key here is with advice, professionally managed, and a multi-asset manager like David or Tom or ourselves who can make those calls for you. So it's not looking across the spectrum and trying to decide for yourself, where to put your money, because I think that is the hardest thing to do.
I agree. I mean, there's certainly been a lot of talk. I know you've probably been privy to it, Peter, across the Middle East, where lots of people are going around, just manage your own money, invest on a platform, just buy your own stock. There's never been a time.
Yeah.
There's never been a time also where you actually need a proper fund manager, a financial planning firm to actually sit down, assess the risk, and actually deploy capital properly, right? Doing it on your own is tough at the moment if you don't know what you're doing, and even when you do know what you're doing, it's also hard as well, right? Perfect. All right, well, we'll wrap it up there, gents. Thank you so much for your time today. That was really, really, really informative. For anybody watching the webinar, if you want more information from David, Peter or Tom, feel free to email us on info@finsbury-associates.com or speak to your advisor. Again, Peter, David, Tom, thanks ever so much. Have a fantastic week. Enjoy yourselves, and look forward to the results and speaking again soon.
Yeah, thanks, Greg.
Perfect.
Cheers, guys.
Thank you very much. Stay safe,
week.
everyone. Bye-bye now.